Have you ever tried to follow a road full of twists and bumps, but then looked at it from above and realized there's a smooth path underneath? That's exactly what a moving average does. It takes all the noise, ups and downs of price and smooths them out so you can see the true direction of the market. A moving average is one of the simplest and most widely used tools in trading. It takes the average price over a certain number of candles and updates it with each new one literally moving as new data comes in. So what does it show you? It tells you the trend direction. When price stays above the moving average, it usually means the market is trending up. When price stays below it, it's trending down. Now, there are two main types of moving average. The first one is the simple moving average. It takes all closing prices for a set period and divides by that number. The second is the exponential moving average. It gives more weight to the most recent prices, making it react faster to new movements. Here's an easy example. A 50-day simple moving average on EUR/USD adds up the last 50 closing prices and divides by 50. Each day, the oldest price drops off and the new price is added. That creates a constantly updated average that follows price smoothly. Think of it like calculating your grades in school. If you average your last 10 test scores, that number moves every time you take a new test. It gives you a sense of your performance trend. Are you improving or slipping? The moving average does that for price. Now, let's talk about why traders love the moving average. First, they help you see the trend more clearly. Instead of getting distracted by every small candle, you focus on the big direction. Second, they can act as dynamic support and resistance. Price often reacts around them, bouncing off the moving average in trading markets. You can use different time frames for different purposes. Short-term moving average like 9 or 20 react fast and are great for quick trades or momentum shifts. Medium-term moving average like 50 show the core trend. Long-term moving average like 100 or 200 act like the compass of the market big picture direction. Let's make this more concrete. Imagine you are hiking a mountain. The 20-period moving average is like the trail under your feet. It changes direction with every turn. The 50-period moving average is the general slope you're walking on. The 200-period moving average, that's the mountain itself, the long-term direction. Now, traders also use moving average crossovers to find possible entries and exit points. When a shorter moving average crosses above the longer one, it's called a bullish crossover, a sign that momentum might be shifted upwards. When a shorter moving average crosses below a longer one, it's a bearish crossover. Momentum might be turning down. One of the most famous examples is the golden cross and the death cross. The golden cross, when the 50-day moving average crosses above the 200-day moving average, often seen as a strong bullish signal. The death cross, when the 50-day moving average crosses below the 200-day moving average, often seen as bearish. But here is the thing. Moving average, they don't predict the future. They react to what already happened. That means they can be a little slow, especially in choppy or sideways markets. Think of it like steering a big ship. The moving average shows you where the ship's been heading, but if the wind suddenly changes, it takes time to turn. That's why traders combine the moving average with other tools, like the support and resistance, or structure to confirm setups instead of relying on the line alone. Another tip: pay attention to the angle of your moving average. A steep upward slope shows strong momentum. A flat line means the market's resting. A downward slope means weakness or reversal. Let's go through a simple strategy example. Suppose you're trading the 15-minute chart. You plot a 20 exponential moving average and a 50 exponential moving average. When the 20 crosses above the 50, you look for buy setups. When the 20 crosses below 50, you look for sell setups. You stay patient when they are tangled, because that means no clear direction. But the real magic of moving average isn't the math, is the clarity. When the market feels chaotic and moving average gives you a structure, it's like zooming out from the noise and finally seeing the flow. So let's recap what you've learned. A moving average smooths price data to reveal trend direction. A simple moving average reacts slowly. An exponential moving average reacts faster. Price above the moving average, bullish bias, below, bearish bias. Crossovers can hint at reversals or continuation. The moving average works best in trending markets, not ranging ones. In other words, the moving averages are like the compass of your chart. They don't tell you where to go, but they keep you pointed in the right direction. Steady, simple, and consistent. So, in short, the moving average doesn't predict the future. It helps you see the truth behind the noise. And in a world full of market distractions, that clarity is priceless.